And maybe I'll give you a bit of history, and might be good for the audience to learn about how impact investing in global health kind of evolved. So the first fund in this space was a fund called Global Health Innovation Fund (GHIF), and actually Grand Challenges, along with other global health institutes, were investors in that fund. That was mainly a biotherapeutics fund, also a vaccine fund. And the kind of initial evolution of global health equity investing was to really focus on the traditional areas of global health, which are vaccines, therapeutics, etc. Ones that could, potentially exit with a very good return for their investors, but also be able to be used by global health funders that are in the therapeutic space, or provide supply chain for these type of therapeutics into those markets, which is a very, like, it's a much more well established, robust, mature infrastructure in these markets. Fast forward, I'd say 5 6 years. Cross border ventures is probably the second. Well, would actually say it's probably the third fund now in global health that's doing equity. And our thesis is a little different. One is we're a smaller sized fund. We're at around 90 million USD. So for us to invest in therapeutics and vaccines at a $3 million check, that just doesn't make sense from a return investment perspective, but also doesn't make sense from the idea that we ask for board seats in these companies. So we're very serious about the global health component to this, and that's hard to do when you're a $3 million check trying to invest in like a $60 million round. And so fast forward to where we are today, where cross border sees a lot of the innovation and potential in these markets is around software. So there's a lot of things happening, obviously, around AI, a lot of things happening around med devices, a lot of concepts around distributed care that are taking a lot more. There's a lot more uptake in these markets around distributed care and decentralized kind of diagnostics and those kind of things that they might actually move forward ahead of North America because the infrastructure has not been built there. And so looking for innovations that want to potentially look at kind of gain or potentially use those advantages in these markets is kind of where we would kind of lie in terms of thesis. So we're very much, when we look at the investments, the first thing I would look at is, we typically only invest in med devices, digital health. And so that's kind of criteria number one. Criteria number two is, we are an impact investor. So we do believe that in venture capital, the typical holding period is only like 4 to 5 years on a good investment. Obviously, on a longer term investment, one that taking longer to exit will take about 10 years. But if our holding period is only 4 to 5 years, it means we have to get the return case right, but we also need to get the impact use case right. And because when you think about an acquisition, the acquirer needs to see the value in the global health use case in order to continue it. And there's plenty of examples of where that has happened and not happened in global health after post acquisition. And so for us, that's why it's very important for us to think about, can this company produce impact? And what I mean by impact is, can they develop a commercial use case in these markets that the acquirer will value post kind of the acquisition. And then I would say, then we would start going into the actual due diligence of the company, right? And so looking at management team, financials, forecasts. We do a lot of technology analysis. I mean, AI is obviously a very fast-moving field. We've developed some criteria in-house on like assessing maturity of the AI models, those kind of things. I would say probably at this point, 75% of the deals we see have some AI component. And as someone who's kind of peripheral to these this type of technologies, people write a lot of things and say a lot of things, and once you pop the hood, might be totally different than what you actually, what's actually been presented to you. And so it's really important for us to develop those capabilities in house, to grow and to have those learnings. And so technology evaluation is very important to us. And then obviously we need to look at the deal terms, right? Given that we are a return investment shop, we do need to see whether we can get a good exit, who the acquirers are, those kind of things. So it kind of helps you. It kind of gives you the concept of how we underwrite deals at cross border. Um, and I'll give you examples of companies. I think that's also really important. And I'll give an example of a Canadian UK company, which I think you've spoken to, is a company called Oxcan. So they invest. They're essentially early stage lung cancer diagnostic. This is a little different from our typical thesis because it's pre-commercial, but they've got very good ties with Princess Margaret. They're doing a lot of work in Oxford. It's a proteomics liquid biopsy test for early stage lung cancer. But what we really liked about this company is that they had a very global outlook from day one. So they had done a lot of work in India regarding biorepositories and trials. They were potentially doing some work in sub-Saharan Africa. They were talking about potentially having a very good diverse database. But then all the other return aspects of the profile needed to come into to place, not just the impact, right? So we had to make sure that we understood the liquid biopsy market really well. We had to ensure that in terms of competitive analysis, whether the technology really stacks up, and are they too late in the game, or are they too early in the game? And then we had to really look at the transaction itself. Did the deal terms make sense to us? Do the syndicate coming together, who had they had diagnostic investors, does that make sense for us? Because as an investor, you can't be good at everything, and we're not going to pretend to be oncology investors. We're not, but we are healthcare investors, so we have an understanding of that market. But it's all around also, who are the experts coming into the table, who are the syndicates coming together, and that's kind of how we got comfortable with that particular investment.
Got it. Got it. No, that's really great overview views. I'm just curious about the, like, if say I'm a company that is I'm just going to use, maybe we can use this example that I'm seeing on your website called a mom incubators. Actually, I'm
Sure,
not even sure if that's exactly how you
that's correct.
pronounce
Yeah,
it, right? And the reason why I'm picking on this organization is primarily because I was a premature baby. Maybe that's too much information, but so I was like, oh, this is kind of interesting. So is it there's a group like that. If I'm mom, I come over to you and I say, hey, Cyriac and Cross Border Impact Ventures, I have this idea that, hey, you know what? Incubators, when you have an incubator in Canada or the US, it's super expensive. I don't know. It's something ridiculously expensive, right? To treat a premature baby, right? Right. We believe we can make something cheaper, much more economical, much with all the right profiles, right? To clinically, and we believe because it's cheaper profile, it'll both serve existing markets in developed world and then the also developing world as well because it's cheap enough, right? Is that like the first thing I have to say to you for you to go, huh? All right, Lester, that's interesting. I will
yeah.
hear you guys out. Is that
So,
fair? Like, go ahead.
so yeah, yeah, and like I won't, I can't go into too much detail about mom because I wasn't the lead like the main underwriter of that, but I know the full kind of the story around it. So, mom is incredibly impactful company, mom incubator. So they essentially have the company has essentially created a incubator for neonates that can work, that are battery operated, that doesn't require all the infrastructure of a typical incubator. And this works well for decentralized care. In the US, particularly around being able to take home neonates that are like considered low risk and and are able to go home to the parents and still have this kind of monitoring system and a NICU system where they don't need to stay in the neonatology department. And so, from the dual market perspective, that's kind of what was appealing to us because we do believe that there is a decentralized ability to bring these neonates home. But what mom had done is that they already had their CE marking, so they already had data. They were already in the market. The second thing that they had done is they were already in developing markets. So I don't want to use the word developing markets. They were in Ukraine. They were actually used in the neonatology sites in Ukraine as the like the as the infrastructure literally started collapsing around Ukraine. There was an incredible need to have battery operated, very low infrastructure neonatology units available. And so a lot of the work we do is seeing whether the innovator has a good high income use case, but have they done it before in the developing markets? Because it's very easy to say that we're going to get into these markets and these are great health systems, and like that's great analysis, but the difference between actually doing it, I've found out over the last 5 years of experience and talking about it is two different things. So we typically put a lot more weight on a innovator who's in both markets.
Got it, got it. And I don't know how you did this, Syriac, but you somehow have like you're like almost wanting us to have a conversation about you're like about down south. Given that you somehow you brought Ukraine into it, you talked about
Yeah.
USAID, but we'll sidestep that for a bit first. But the one thing, so okay, now you see I presented to you the my use case, my problem set, and then the proof points, and you say, hey, you know what, check because it fits our thesis around decentralization. It fits the proof point that we need in terms of you can go into developing markets, right? Then when do you start looking at the financials? And I'm not, let's take mom out of it because I don't want to go
Sure,
into
sure, sure,
specifics.
sure. Yeah.
But what does the financials have to look like from both you talked about exit and also maybe also from a cogs or a cost of goods, so like how much something costs to actually make and how much you can sell it for. Like what does that have to look
Sure.
for you to say, hey, you know what, this is worthwhile to even go in deeper?
Yeah, that's a good question. So typical venture capital, you're looking at 3 to 5x of your cash, like making money on your cash, so what they call cash on cash. So you're making about 3 to 5x of what was invested. Then you have what we call IRR, right? Internal rate of return. You typically want to hit around 30%. And that basically is a very easy calculation in the sense that you weight the number of years into the number, how much you've invested, into how much you get out of it in terms of profits, right? So those are some like financial modeling things that we need to do. And a lot of that is based on looking at current competition, where the exits are, who are the acquirers, what are the acquirers doing, what is their track history, etc. Right? And so, if I was to look at a med device, let's assume it's in the diagnostic space, then I would be looking a lot at what Roche is doing to bring point of care into those markets or something like that, right? So from the financial perspective, there needs to be a liquidation event, and it needs to meet certain criteria where we believe that this company has a chance. The difficulty of all of this is early stage companies are very hard to predict where things are going. One, they could be going one direction, the next year they're doing something else totally. When you start looking at more mature companies that are in revenue, let's say $10 million of revenue, that's a lot more forecastable. And so a lot of this is, part art, part science, and sometimes I say part science fiction. So you have to, you have to believe, but you need to have some sort of thesis. The second thing is you need to have a thesis in terms of like what makes sense for you, where you see the medical ecosystem growing, where you see there's tremendous opportunities. And in our outlook on this is very different than a typical medtech investor. So I would say most of the deals we see, but 95% of them have no developing market use case and shouldn't. And in fact, sometimes I tell innovators, you don't even go into these markets. You can make a lot more money just staying here. And so we have to be very narrow in what our outlook is, and where we have certain theses where we think this has a good dual market strategy. And I talked a little bit about that, distributed care, potentially bringing AI into clinical decision support. Those are things that are more believable than bringing in something that has like a high computational EHR component to it. Like those things don't really work in these markets, right? Or at least the markets are not developed enough to have that kind of system. So over time you kind of develop your thesis, but it gives you an idea of how we view these things.
Awesome, awesome. So is that enough once you look at the problem, the solution, the proof point, the financials kind of make sense? Is that like, okay, now we're gonna impact ventures, we're gonna sign a check
Right.
for company X,
I
or
I
is there more to it than
I
even
wish it was that simple.
okay?
Unfortunately, it's not. A lot of it is also just hard nosed financing work. So like there has to be a actual financial close. There needs to be a syndicate of investors coming in. Cross the border at 3 million. If you're typically investing at a 10 million like total round, well, you need others to come in. There needs to be alignment on board and terms of the deal, and there's various financing mechanisms on like liquidation preference tax and all those things. That's kind of the hard-nosed financial aspect of all of this. Once the do you like the deal component is you get comfort over that, right? Because it also needs to make sense from a transactionary perspective. You don't want to be invested. So there's some deals we thought were wow amazing. This could really work. It's got a $200 million valuation. So like, do I want to invest here? I may, odds are I probably wouldn't get a board seat, and this could be a lot like the return profile is not that good, right? Because you're such a late stage investor. Even if the company exits, it might exit for $250 million. Well, then you're not making 3 to 5x of your initial investment or that IRR. So all that portion of underwriting needs to all come together. And right now, the finance market it's not easy. A lot of companies are raising money, so there's a lot more supply than venture capital is allocating, which is demand. So there is quite a glut of like companies looking for money, and that's just indicative of the financial market today. But those are the things that need to come together in order for us to invest.
Got it. Got it.